Good morning. Welcome to Trading Hour. I'm Sonia Shenoy. With me are Prashant Nair and Pavitra Parekh. It's absolutely flat for the market right now. Just consolidating. The mid-cap index is actually doing quite well, up almost about 0.5%. The Nifty, though, has given up its early morning gains, has moved into the red terrain. The good part is that the Nifty is holding on to a lot of key levels on the downside, whether it's the November low, whether it's the 50 as well as 20-day moving average. Those are being held on to for now. 18,200 is a level that has been supported. The 20-day DMA comes at 18,000. The 50 DMA is at 18,124. So that's something that's holding on the downside and being protected. Other than that, a lot of trends in the market today, whether it's diagnostic companies that are on the rise, mid-cap PSU banks are looking pretty good. So all in all, turning out to be a little bit of a lackluster day, but I think a lot of stock-specific action is what we're seeing today.
Sonia, too late in the year to start on anything new, right?
Yeah.
Just 6-7 days to go, and I think it'll be okay. The market just kind of middles around here, doing nothing. 18,350 off the opening highs. It's a reverse of what we saw yesterday, actually. Yesterday, we saw a near 200-point pullback. So far, I mean, it's a 120-odd point pullback on the other side from the day's high. Overnight Qs were absolutely flat, so this is not very much to kind of, it's a flat day so far, unless, of course, we get big moves like what we've had over the last 5 or 6 days. And we've had those very large intraday moves. Let's see if today is one of those, or, I mean, I would much rather prefer it's sideways with not very much action. Pavitra, hi.
Hi, good morning. So, like you said, we have come off the high significantly, but this is something that we've seen across the Asian markets as well, right? So, Hang Seng Taiwan now just trading with a gain of around 0.25%. Nikkei, after moving into the green, is now seeing a cut of around 200 points. So, do keep that global setup on your radar as well. For our own markets, in terms of sectors, it is the Pharma pack and the PSU banks, which are once again moving higher. Of course, after the downtick that we did see yesterday, a few of the tech names also doing quite well. So those ones will be up on your screen, the likes of HCL Tech, Tech Mahindra, all of them on your screen. And on the downside, it is really the consumption name. So something like a Godrej Consumer is down almost 2%. You have Britannia, Tata Consumer, all of these seeing some cuts in Reliance also. One of the top losers on the Nifty today. So that's what's happening with the market action. But let's now start by focusing on the real estate space. Ambit Capital has put out a very interesting note. We were telling you about this yesterday, where it is bullish on the Ahmedabad real estate market. And it is actually drawing a comparison with the boom that we saw in the Hyderabad market. Remember, the city has clocked in more sales than even, Kolkata, Chennai in the first half of this year. That is the first half of FY23. So to discuss, we are joined by Pavitra Shankar, Executive Director of Brigade Enterprises. Pavitra, good morning and thanks a lot for joining us. First off, do you agree with this view that, Ambit has put out, where they see Ahmedabad as the big new market for real estate? They're drawing that comparison with the kind of huge boom that we saw in Hyderabad as well. And are you excited by this market?
Hi, good morning, everyone. We actually have a presence in GIFT City, Gujarat, not so much Ahmedabad. Brigade is primarily a residential developer with a strong portfolio of commercial, office, retail, and hospitality assets. In GIFT City, we have an office building and a hotel. So far, we have not seen GIFT City per se take off from a residential perspective. I understand Ahmedabad is a slightly different market. It is a smaller market, so obviously the potential for growth of a smaller base will be higher than, say, what we see in our larger markets. But Brigade per se, we focus more on South Indian markets like Bangalore, Chennai, and Hyderabad. Personally, I feel it will require some more time for Ahmedabad to get to that kind of size and scale in terms of overall demand. I think probably what is the potential opportunity in the financial services sector coming from the GIFT City demand and some manufacturing demand that can come in through Ahmedabad. But for us, we see a lot of our driving force of growth coming from the IT sector, and that is why we're very confident about southern markets like Bangalore, Chennai, and Hyderabad.
Okay, Pavitra, hi. Since you spoke about, GIFT City, I wanted to ask you a little more about the commercial, the potential over there, because there is this narrative that higher interest rates could impact the commercial rates. I mean, we saw it with BlackRock closing its real estate fund because of higher redemptions. Globally as well, things are not looking that good as interest rates peak. Are you noticing any sluggishness? I'm talking about the commercial portfolio.
Actually, I think there is still some sort of dichotomy between what we're seeing on the global scale as well as in India. Of course, what happens globally does have some kind of impact on the Indian commercial leasing outlook. That said, the absorption has been very good in calendar 2022. I think the impact, what we are seeing is mostly from slowness in decision making. A lot of the recession talk in the US and Europe has impacted the speed of taking decisions in terms of lease up in a market like India. But that said, India is the bright spot in the global economy, for the next couple of years, at least with the outlook that we have for economic growth as well. So I think that many of these companies are looking to India to maybe lease up, to expand their presence and therefore lease up their office presence. Also with a lot of work from home reversing and people coming back to the office, it has also been easier to get people back to the office in India than they have in the US and Europe. So due to that perspective, I think the leasing outlook in India is far better than what is there in the US. And that's also potentially why Blackstone was looking at those redemptions.
And always easier, Pavitra, to get people back into a swanky new shiny office, right? So, I mean, a good office makes a lot of difference.
We need to do a lot. Yeah, we need to do a lot on the tenant experience to get them back to office. But, we are seeing the trend of people coming back.
Yeah.
Trust me, however swanky the office is, if you get a chance to work from home, people would take that.
Yeah, I would work from office. I would work from office.
Really?
I mean, I worked through office through the COVID. I mean, I think I worked 2 weeks or 2.5 weeks from home. But that's also
because for our industry, it's just a nightmare to work from home.
Yeah. No, but Pavitra, just a quick point. There is even no temporary slowdown in office leasing, etc., because of the talk of a potential recession, etc. There's nothing. The offtake is as strong.
No, I would say that there isn't any, I mean, we can't say there is total exuberance in the office sector. It is definitely a challenging time to lease up and so on, but there is good demand. But maybe what we had expected or what the general outlook was, I would say about 10 months ago, prior to sort of the Ukraine-Russia war really sort of, escalating to where it was a very, very positive outlook. Since then, things I would say are not as positive, but what is happening on ground is sufficient to sort of give our teams the confidence that we can still lease up whatever remaining vacancy is there in our portfolio. And there are still companies scouting for space. Organizations in India or multinationals who have presence in India are still seeing good demand, prospects locally. So they are still looking for, and they are still rejigging their workplace strategies to figure out what's the best way to get their teams to come back to work.
Okay, that is on the commercial real estate. Also, you briefly mentioned the conversion rate that we are seeing. So can you tell us what that's looking like just for the residential market as well? Say 10 people, if they come to see the house, how many actually end up buying it?
So, I mean, historically, I would say from a lead to when a lead is generated to when people come into the site, that's generally around 20%. And then of that, maybe another 10 to 20% may convert on the ground. But in terms of overall demand, we have actually not seen any slowdown on the residential sector. This is despite prices increasing. We have also taken up pricing across our portfolio consistently.
We're actually facing a bit of a scratchy line there, so apologies for that. But we've got a gist of what you said, and it's good that you ended on a strong note saying that there's no slowdown in demand. Have a great year. If we don't see you again, greetings of the season to you and your entire team at Brigade. But let's now cut across to the RBI Governor Shaktikanta Das at the Business Standard BFSI Insight Summit. Let's listen in.
Because I am not often, but I am sometimes reminded by people that I am supposed to have done history. So.
Yeah, but your work and policy work speak for you, not your.
But in a more serious note, let's get going. Yeah.
Okay. Shailesh spoke about this cryptocurrency. I remember in November last year, we had a fireside chat with you. That was in your room in Reserve Bank of India, 18th floor. It was telecast and webcast and all. And there, very strongly, you waged a war, if I may say so, against cryptocurrency. 13 months back. So you have won the battle, you think? Because finance ministry has all along been, till recently, ambivalent. So the cryptocurrency war is over? You think you're a winner?
No, there is no war or anything like that. You see, we firmly believed and do firmly believe even now that cryptocurrencies have absolutely no underlying, and we have been sort of, I think a lot of noise is coming from. So, cryptocurrencies have certain huge inherent risks for our macroeconomic and financial stability. And we have been pointing it out. And the developments over the last 1 year, including the latest episode of the built around this FTX, I think after all this, I don't think we need to say anything more about our stand. I think the time has proved that cryptocurrencies are worth what they are today. And according to some estimates, the total value of cryptocurrencies was about 188 billion or 190 billion, 180 billion, but now the valuation, has come down to about dollars, has come down to about 140 billion dollars or so. About 40 billion value has got really wiped out. But change in value in any so-called product is a function of the market. But unlike any other asset or unlike any other product, our main concern about crypto is that it doesn't have any underlying whatsoever.
Sure.
I think the term cryptocurrency, private cryptocurrency, is a fashionable way of describing what is otherwise 100% speculative activity. And there is a talk that, it should be regulated. Now, how it is to be regulated, somebody needs to explain. But I would like to just mention 3 points. One, the origin, the cryptocurrencies, the private cryptocurrencies owe their origin to bypass the system, to break the system. They don't believe in the central bank currency. They don't believe in the regulated financial world. They want to bypass and beat the system. The second thing is that they have absolutely no underlying. And not only that, I am yet to hear any credible argument about what public good or what public purpose it serves. There is still no clarity about it. And third, as I have said, it's 100% speculative activity. And I would still hold the view that it should be prohibited. I mean, countries have been taking different views, but our view is that it should be prohibited, because if it is allowed to grow, that if you try to regulate it and allow it to grow, please mark my words, the next financial crisis will come from private cryptocurrencies.
Okay. You are reiterating what you said. So, sir, we have a series of, I have a series of questions. I don't want to get into only GDP and inflation. So, little different thing, you launched CBDC, pilot projects launch. But can you just very briefly explain to us, I mean, how do we, what's the use of CBDC? Because you said it's currency, it's like currency notes, it's anonymous, and that's it. But what is there? I'm happy using UPI and all. Why do I shift to CBDC? It's just an optic to fight crypto, or there is something meaningful for me, people here, to use CBDC for the retail?
No, I'll explain why. I think in the monetary policy press conference, in the post-monetary policy statement press conference, I did explain about the difference between UPI and...
anonymous, you said.
Sorry?
This is anonymous,
between,
like cash.
Between UPI and CBDC. The first thing is UPI is a payment system. CBDC is a currency itself. That is number one. Number two, as I explained, UPI involves the intermediation of banks. You use through the mobile, you pay somebody, then my money gets debited from, the message goes to the bank, my account gets debited, the bank transfers the money to the bank of the, to your bank account. Your bank account sends a message to you that, so much money has been received. So there is an intermediation of bank. CBDC is like currency notes. You go to the bank, you draw it, you keep it in your purse, and you spend it. And What is more about CBDC is that there is an automatic sweep in and sweep out facility. 24 hours, you can draw CBDC, and if you are carrying excess CBDC, you can put it back into your bank account. So there is an automatic sweep in and sweep out facility. The second or third, whatever point that may be, the third is that the huge logistics, the cost of printing around printed notes, that is not there. You know, manufacturing paper, getting the ink, having a printing press, all that thing will become outdated over a period of time. Logistics-wise, CBDC will be much simpler, and it will be much faster. Next point is for international transactions. When two countries have their own CBDCs, it can be instant, remittance, instant money transfer between one country to another country. The whole world is going towards, is becoming more and more digital. Almost in every sphere today, you have digital activity happening. You will see in the coming decades, now many central banks are still in, experimental stage. They're still analyzing. Some central banks have started pilot projects. But you will see in days to come, more and more central banks will embrace digital currencies. And India has been in the forefront of the digital revolution in the current, in the current century. So therefore, we have to be in the forefront. It's not a question of fear of missing out, or it's not a question of offering competition to a private cryptocurrency. I think that is how the world is going to evolve. That is how the digital world is going to take shape in the days and years to come, and we have to be ready for that.
So it's a currency of the future.
It's a currency.
Sir, you said that you are a student of history, but let me take the liberty of asking you about economics, which you know better than many economists. So how decoupled is India from the rest of the world? Because that's also be the subject of our discussion with the economist, the last show of the thing. And in that context, if you can just very briefly, because I have many more questions to ask, I mean, how long US Federal Reserve will continue to be the big daddy? I mean, we want it or not, our eyes in on the FOMC meeting, your MPC, one or two members can dissent, but the collectively Reserve Bank of India and MPC is always, you use that Arjuna's eye, so that it's FOMC, what is FOMC doing, is it slowing down, etc. So is it, I mean, there is no escape from that?
No, you see, being the largest economy in the world, naturally what the US Fed does, it matters. It matters to everyone. And a large part of global trade is also dollar denominated. So therefore, what US Fed does is definitely important for everyone. But so far as our monetary policy making is concerned, so far as our other decisions are concerned, we are largely guided by our domestic inflation growth dynamics and several other international factors. Actions of US Fed are considered, are studied, but that's only one of the factors. It's not as if something the Fed does and we will have to sort of follow that line. And so therefore, we are primarily, and I have said it earlier also, our monetary policies are governed and driven primarily by our domestic growth inflation dynamics. Actions of US Fed do impact our domestic situation because, like if, there's a tightening, let's say the dollar becomes stronger, naturally the price of our imported, we are a commodity importing country, naturally the price of our imports, the crude, petroleum crude and other imports will go up. But we are not, nobody is anybody's big daddy. In the current world, everybody has his own space. Okay. And I think the days of Big Daddy and all that thing is 19th century. It's no more the case, but yes, US is a major player. But let me say that primarily we are governed by our domestic, and I mean, when I say it, I really mean it.
Okay. Sir, you brought in the two words which I thought would avoid, inflation and growth. So tell me, I mean, 10 months in a row, Reserve Bank of India failed to contain inflation within the band, which is nothing new about, I mean, everybody knows, and it has, as we speak, it has gone within the band, etc. But historically, very often RBI's estimate of inflation is off the mark. actual inflation is higher than RBI's estimate. So one could be we need to take a look at the composition of inflation, or other could be Reserve Bank of India needs to take a look at the assessment of inflation. Where are we?
No, we constantly keep on fine-tuning our models of inflation forecasting. But any forecast, whether it is of inflation or it is of growth, by any central bank, not just the Reserve Bank, is always conditional to so many factors. Now, if the conditions change, if the underlying conditions change or do not happen the way you had assumed, then naturally the numbers will be different. But the last few prints, I think our expectations both on inflation and growth, we are almost getting it to the second decimal, or the first decimal if not the second. So 6.3 was our estimate for the growth of the second quarter, and we got 6.3. The last inflation print, which came at 5.88, let's say 5.9, our expectation was about 20 or 30 basis points, I think, higher than that for the month of November. So sudden developments do take place. We keep on fine-tuning our model. What is important to see in the context of inflation forecasting is not whether you are getting that number right. It is essentially whether you are getting the direction of inflation right. And not only the direction, but also the force of the direction. Whether we are able to read correctly that the inflation is going to go up, is going to go up very fast, or is going to go up very steadily. So it is the direction and the speed of the inflation movement while it is going down or while it is going up, or if there is volatility. So I think it is the direction and speed underlying the inflation, inflation momentum, which is important, not just getting that number right. Because monetary policy is based on the direction of inflation, the broad speed of inflation, rise or inflation decline. We don't go by that, the inflation will be 6.34 or 6.48, something like that.
So talking about growth, Governor, you seem to be pretty conservative. In fact, your latest assessment of growth, you paired it a bit. World Bank's assessment is higher than that. I mean, why this sudden conservatism? Typically, I mean, you seem to be less bullish.
The World Bank, the latest projection, they are talking of 6.9% for the current year. We have given 6.8%. Yeah. Primarily, it is because of the global headwinds. Europe and other countries, large number of countries are facing, facing a very serious growth slowdown. 6 months ago, the talk of, or 5 months ago, the talk of a global recession was much more intense. Now the expectations built around recession have slightly moderated, but the fear of a recession in many parts of the world, or the fact of slowing growth is quite visible in large parts of the world. And they will definitely affect the external demand. And external demand do contribute a lot to our growth calculation and to our, let's say, to our export performance, etc. So it is primarily the international factors, the slowdown in growth all around, the tightening of financial conditions world over. All these factors, external factors, will have an impact on the domestic growth scenario. But the underlying economic activity in India continues to be strong. In fact, the last month's fast-moving indicators, we monitor about 70 fast-moving indicators, and most of them are in the green box. We have this marking of green, we have this marking of red, orange, yellow, green. Most of the boxes in those fast-moving indicators are in the green zone. That means they are all picking up. They're still growing. But external factors are important, and they will definitely cause some, dent on our economy. So we have considered those aspects, and therefore we have adopted this 6.8%.
Yeah, latest November bulletin, which was released yesterday, also spoke about what exactly you are saying. So let's get into from macro to micro, which all these gentlemen sitting here. representing a large part of Indian banking, both foreign, private and public sector banks. They would love to hear your views. This kind of credit growth, what we are seeing year on year, is it sustainable? Do you think that this gentleman actually showing seeds of troubles ahead? Again, we'll get into a bad loan? Or you think that no Indian financial system now knows, the bankers knows risk management, underwriting, everything? Because anecdotally we hear in private bankers are saying, no, risk pricing is not exactly correct. Probably we are going overboard and all. Are you concerned about this? Or is it everything is fine?
You see two aspects. Number one, the credit growth, 17.5%, that is the latest number as of December 2nd, which we have, I think, published, 17.5% credit growth. That reflects the underlying fundamentals of our economy. The credit growth in the previous 2 years were very, very modest. In the first year of COVID, the credit growth was just about 6% or so. The second year, it was slightly better. So on a low base, and that is the second point, the current 17.5% is on a low base of previous 2 years. There is a base effect which is also playing its role here. So it's on a low base. And second point, it is reflective of the underlying fundamentals of the economy, and it is also a reflection of the pent-up demand of the pent-up demand for credit of the last 2 years. So considering all these factors, I think the credit growth at the current point is certainly far, far away from what you call exuberance or something like that. It is definitely very, very steady. We are monitoring it very, very carefully. And while on this point, let me also mention, because this question comes up again and again in any public discourse, that deposits are not growing and credit is growing. So are we heading for an unsustainable situation? I do agree that deposits have to grow. They must grow to sustain credit growth in the long term, in the medium or in the long term. But certain facts also will have to be kept in mind. Just as the credit growth looks very high because of the low base of the previous year, the deposit growth also looks pretty low because of the base effect of the previous years. Because in the COVID period, the deposits were growing by about 10 or 11%. So this deposit growth that we see today, the latest is, I think, 9.9%. That is on a slightly higher base. And looking at the absolute amount, in fact, the December 2nd figures, that is the latest, I was looking at the numbers. From end November 2021 till 2nd December 2022, that is over a period of last 1 year, the credit growth in absolute numbers is rupees 19 lakh crores. The deposit growth is 17.4 lakh crores. Let's say 17.5 lakh crores. So it is not as if there is a big gap between the deposit growth and the credit growth. The base effect of both is making it look that much more divergent. So at the current moment, therefore, I would like to say that the credit growth is reflective of the underlying economic fundamentals and growth of the economy. Sorry for that longish answer.
It's so much homework you do. In fact, you have taken away my second question about deposit growth. Do you think that the banking system is pretty unfair to the saving community? Because you yourself spoke about negative interest rate. And for credit, for the loan rates, you have an external benchmark. For deposits, it's free. So what needs to be done if you want to attract savers to the bankers' fold?
I think all the leading bankers are here. Most of the banks have already started raising the deposit rates. And going forward, they will definitely take a commercial call. They do need deposits. The banks also have a considerable amount of surplus SLR holdings, which they have the option to dip in anytime they wish to. And just to give out some number, because we do monitor it in the Reserve Bank on a weekly basis, the weighted average lending rate I'll just give one example and not bore you with too many numbers. The weighted average lending rate on fresh loans, the lending rates have gone up by about 117 basis points, 117 basis points. You see, I remember 117 because in my student days, there was a DTC bus which had the number 117. So last time when I read the number, that is how, you know, I remember 117. Otherwise, it's very difficult to remember. So, because I visualize that particular DTC bus. So, the lending rates on new rupee loans have gone up by 117 basis points. The fresh deposits, both retail and bulk deposits, the weighted lending, the deposit rates have gone up by 150 basis points, 150. So therefore, deposit rates are picking up going forward. It's a function of the market. Both lending rates and the deposit rates are a function of the market and the Reserve Bank's, policy rate. So I think deposit rates are picking up, and they should, they may even go up a little bit more or further.
Thanks, Governor. You spoke about this 117 bus, but I was wondering that Mr. Dayal sitting here, Chief Communications Officer, CGM, Reserve Bank of India, he probably kept an invisible teleprompter for you, the way you are reeling out numbers. Dayal Sahab, no? Okay, you've not done that. So let's come to,
I'll share, I'll share my own experience. Yeah. The best thing to remember certain numbers is to relate something to your own personal experience. So that is the best way to remember even, like 117.
Governor, this is a little critical question. No, HSBC boss has not taught me this. Reserve Bank of India has two roles. One is the developmental role, meaning about the financial system, stability, etc. Other is supervision and all. But of late, in private bankers says that you are becoming a bit of a micromanager. Like you are running the banking system, not the bankers themselves. Nobody will tell you, nobody will stand up and say, but the little, said RBI, बहुत कुछ भी करता है उसको बोलो. Anything we need to do, you have to tell them. Every question, minute question, they call it quote unquote micromanagement. Is there any validity what they are saying?
I don't know. This is the first time I'm hearing that. I do interact with the, the MDs and CEOs of the banks. I have not got that sense. And apart from the official engagement, I do know a lot of people who work in the banking sector at various levels. And I know personally several people, and I do get a lot of feedback from them about various banks. You have your friends, relatives, or their children working in various banks, so you get a lot of feedback from them. I have not heard anything, but perhaps what you are referring to is the intense and deep supervision that we are doing. Over the last 3 or 4 years, we have really deepened our supervision. Ultimately, at the end of the day, you see, in United States, failure of banks happens, it's nothing unusual. There are cases of bank failures, it happens, everybody takes it. In India, failure of a bank is just not acceptable by the public or by anyone. And everybody looks at the RBI. So it is our responsibility as the regulator and as the supervisor of the banking system to ensure that the banking system is stable, the banking system is robust, and it is ready.
That is an interesting, extremely interesting chat, a very freewheeling chat, as they should be, with the RBI Governor, Tamal Bandyopadhyay, talking to the RBI Governor. Of course, from what is relevant is, of course, the crypto bit. Essentially, the governor taking a victory lap, saying, well, I told you so. He didn't say I told you so, but he did say, I think there is little room for interpretation where he stands. He said, we still think crypto should be banned. There is no underlying reason why crypto should exist. He said, well, if they're allowed to grow, the next crisis will come from private cryptos. That is something he said. And of course, there was a bit of stuff on CBDCs, which is central bank digital currencies, micromanagement of banks, of course. Another interesting question was whether public sector bank and the lending that they're doing eventually at some point in the future will create some sort of a crisis. And the governor saying, well, at this stage, he doesn't believe so. And the lending is pretty, it's showing the underlying demand for credit, which shows the growth in the economy, etc. So interesting chat. Our team is listening, continuing to listen to the conversation. We'll cut back in. For now, we are cutting out to report on markets, which are actually not doing very much. We're down 30 points, 18,357. Sonia, the governor also told us how to remember numbers.
No, but absolutely credit where it's due, right? I mean, I think for over 2 years now, he's had this long stance of how, and he's reiterated time and time again about how cryptocurrencies are a big danger for the financial system. And now he's only come, he said, mark my words, the next crisis could come from private cryptocurrencies. So we should take this seriously, considering that he got it right.
Absolutely, he got it right. And I think only well-deserved that he actually makes a mention of it and puts it out on the record. We'll take a very quick break here. When we come back and we discuss more on markets on the other side. Stay with us.
Hey guys, welcome back. You're still tuned into Trading Hour. And as we wind down on this year, here is our special series. After delivering healthy profits during the pandemic lockdowns, tech giants lost trillions of dollars in market cap in the big tech sell-off of 2022. Not just that, recession fears across the world also led to massive layoffs across the industry. So as we wind down on this year, Rima recaps the brutal year that was for the tech sector. Rima.
It's been a brutal year for tech giants around the world. Apple stock is down about 18% so far, and it is one of the better performers. Facebook owner Meta, Amazon, Netflix, Google's parent company Alphabet have all fared far worse, with Meta plunging nearly 65% this year. The other tech giants of Nasdaq, chip giant Nvidia, Elon Musk's Tesla, are also down massively so far in 2022. What's hurting? Rising interest rates, macroeconomic uncertainty, and global pressures. Recession worries are hurting Amazon and Apple, and concerns about a strategy shift. For example, Meta going all in on augmented and virtual reality, Netflix embracing advertising for the first time ever is also hurting. Let's talk about what happened back home in India. Now, 2022 has marked a sharp decline in stock prices of Indian IT giants as they moved in step with their global counterparts. As things currently stand, this year could be the worst year for Nifty IT since 2008, when the index was down close to 55%. The reason? PED rating, as global interest rates went up, and then there were some EPS cuts as growth forecasts moderated. TCS is now trading at a forward multiple of 25-26 times. The peak was 32 times, and the list goes on, with Infi, HCL all trading at a much lower valuations compared to their peak. The worry is also about what next year holds. Analysts estimate that growth will slow down further. Nomura is saying the US dollar revenue growth to slow down to 8% next year versus 12.7% in FY23 for the big companies. The next big story of 2022 were the tech layoffs. Now, according to a layoff tracking website, layoffs.fyi, data as of mid-December shows nearly 1,000 tech companies have laid off close to 1.5 lakh employees. And that includes biggies like Meta, Google, Amazon. They've laid off thousands of employees. And the question is, will this belt tightening continue next year? And the answer is probably yes. Many companies which have not announced their job cuts yet are likely to do so next year. HP is looking to pull back on its workforce. Reports suggest Google is looking to axe about 10,000 employees next year. And here we're only talking about the multinational tech giants. There are so many smaller startup companies where we are seeing some big job cuts too. But the biggest newsmaker of the year for me is Apple, which moved its iPhone 14 production to India. Now, Apple has been assembling smartphones in India since 2017. But up until this year, Apple used the manufacturing facilities in India to assemble the older generation handsets, the legacy models. This year, 2022, was the first time Apple produced the latest smartphones. They produced the phones as the same year as its release, just a few months of lag compared to China. And the story is we've just gotten started. According to JP Morgan, every fourth iPhone will be made in India by 2025. What's the driver of this big shift? China unrest, reduce your dependency on China, and an affirmation of India's PLI scheme. According to India Cellular and Electronics Association, India is likely to export handsets worth $9 billion in FY23 versus $5.8 billion in FY22, a whopping jump of 55%. And this is the big question as we step into 2023. Can India become the new smartphone manufacturing factory for the world?
Okay, well, I just couldn't take my eyes off all that technology on the screen, right? I mean, forget about talking about the tech stocks. Visually, it was like such a treat to just watch.
It was looking like, I was saying, we look like the metaverse, right? It's really high fun, that stuff. Looked fantastic. So that's, tech in focus with Reema, and we'll get you many more wrap-outs for the year across a variety of areas, topics, etc. As we wind down over the next 2 weeks or so. We'll take a quick break. We're back. More on markets on the other side. Stay with us. Well, let's shift focus to mutual fund world. Pavitra is standing by the big wall with some interesting data on asset ownership and scheme contribution trends. Pavitra, over to you.
Thanks a lot for that. Well, we have been going through the mutual fund data, and while there is a steady rise in the total assets managed, we have picked up some interesting trends. So first, just the broad numbers are going to be up on your screen. So the total assets managed this month came in at 40.5 crores. This is for November of this year, and this is a 5.1% rise over what we saw in November of last year. That's November of 2021. So over here, the assets were at 38.45 trillion. Now comes the interesting part. Assets held by individual investors have increased more than 10.5% in this period. So we have a figure of 23.34 lakh crores. This is for November of this year versus the 21 lakh crores that we saw in November 2021. Compare this to what is happening to assets held by institutions, because the trend is quite the opposite. So institutions held 17.36 lakh crores in November of last year, and this has actually slipped to around 17.15 lakh crores. So while individual investments are on the rise, assets held by institutions have declined 1.2% versus last year. There you have that divergent trend. Another interesting trend is that equity scheme contribution to total assets has been going up. So you have the chart on your screen, and like you can see, the contribution was at 48%. This is in last year, and that has been moving higher, and now it is currently at 51.7%. Now, if you look at the contribution coming in from debt schemes, you're seeing the opposite trend play out once again. So the debt scheme contribution is down from 28.5% last year, and it has slipped to around 19% now. So the current pie, if you look at it, has a large, almost 50% chunk from equity schemes. You have 19% from debt, and the rest is, of course, ETFs, FOFs, liquid funds, all of that. So to wrap up, the key trends that we're picking up is that the total AUM is rising for the industry, but assets held by individual investors are rising, but those held by institutions have actually come down. The third sort of trend that we want to point out is that equity scheme contribution is rising, but debt scheme contribution, on the other hand, has been slowly coming down. With that, guys, it's back to you.
Okay, thanks a lot, Pavitra, for that. Very helpful there. A snapshot of what's happening in the mutual fund industry. Let's slip into a quick break. We'll get more on the equity markets on the other side. Stay tuned. Welcome back to Trading Hour on CNBC-TV18. Well, for now, the market is so very quiet, but the broader markets have picked up a bit of pace. So there's a 0.5% rally that we're seeing there. Plenty of stocks are hitting fresh highs, even in the broader market. So let's take a look at that. You have something like an Apollo Tyres that's hit a fresh high today. There's Jindal Stainless that is at a fresh 52-week high. There's something like, of course, from the larger names, there's the Axis Bank, Adani Enterprises sitting at fresh 52-week highs as well. But from the smaller guys, something like a GE Shipping, which has had a fabulous run this year. It's been one of the strongest stocks in the broader market. It's up 146% this year, and GE Shipping is now up almost about 1.5%. That's a new 52-week high. So the headline index may be flat today, but there are plenty of stocks that are scaling up. Let's wrap the show on that note, but we leave you with some market opinion, this time coming in from Sanjeev Prasad of Kotak Institutional Equities. Thanks so much for watching. In a bit, we'll continue with the coverage on the market. Stay tuned.
Market hasn't done much in 2022 also. So last 15 months, if you take, let's say, from September end of 2021, It's been pretty much in that 18,000 plus minus range only, barring a bigger correction in May and June. People are obviously very worried about high inflation and high interest rates and so on and so forth. So market is as of now, in a consolidation phase. Valuations are rich. And the second thing which we have to figure out is, how long do the central banks, including the RBI, hold interest rates? So as of now, we're getting some comfort on the fact that inflation seems to have peaked in some countries, peaking in others. So hopefully, as far as the actual central banks are concerned, they are probably reaching terminal or peak rates as far as the current monetary cycle is concerned. Pharma, honestly, you have to look at it on a more bottom-up basis. They have their own challenges. Many of them, US generic pricing, clearly there is no pricing power. You can make some money as long as you have a new product launch for it and you have some exclusivity around it, but that's about it. So, the stocks which you like in the pharma sector are more the domestic-oriented stocks because, you are seeing decent amount of, growth over there. Most of at least the domestic part of the pharma company, that seems to be growing at about 11%, which is actually quite decent. And that's probably the business which we are much more excited about currently.